The market is a fickle mistress, but for those of us who absolutely love it, we learn to deal with it. And what we're going to discuss over the course of just the next few minutes in this quick teaching is how we actually deal with the market when big things happen. And what are big things? Well, what we've learned as we've studied the market for, going on 12 years, 15 years, it's been a long time, is that the most important changes are when big waves hit the market. And the biggest wave we follow is the weekly chart. The weekly chart, again, is reflected on our charts primarily by the indicator we use the most, which is the price percent oscillator. We have good teachings on that, and it's very much like the MACD, for those of you who are familiar with the moving average convergence divergence. It's calculated just a little bit different. Instead of being an absolute, it's actually related to percent, which means that it's easier to compare indexes to particular items in the index. Like if you're looking at the S&P 500 and you might be looking at a smaller subset or maybe just a single stock, you can actually use the PPO instead of the MACD to be able to see if really the highs in that stock reach the same highs on the PPO as the index, which allows you to compare and contrast. You can do the same with stocks. You can do the same with bonds, bond funds, all those kinds of things, which we found based upon actually a recommendation from one of our friends, one of the viewers, the listeners to the show, recommended that, and we studied up on it and changed over several months ago. We like it. We're going to continue to follow it. But what we find so interesting is when you have major changes, when the PPO rotates over going up or rotates over going down, what we've learned to do is instead of trying to predict when the market's going to go down, because it looked like it was starting to head down actually on the 26th of August in 2016. What did it do though? It did go down for a few weeks and then bounded back up again. But once the PPO crossed over going down the week ending the 21st of October, the market actually did drop off pretty significantly over the next 1, 2, 3 weeks. And then it recovered. It took it a while, slid sideways for a while, and then crossed over first on the 2-day chart going up and then on the weekly chart. In fact, the most successful trade that we have had so far, and again it started on the week ending, the week ended the 6th of January, and then on the 9th we actually did a buy-in after idiot hour at 10:30. And again, the way we do that is we want to make sure that the 2-day chart is still in an uptrend, and we've been experimenting with jumping into the market after idiot hour at 10:30. And if you would have bought in at that time at 121.30, actually the market has zoomed up since then. The highest high that we've had on the weekly chart was 125.92. That was at the end of the prior week of the end of the week ending the 27th. So that is a pretty decent gain, and the market is continuing to go up. We do see a little bit of pairing off of that upward activity, but so far in the new week, as we broadcast this, as we prepare this on Monday the 30th, things are still going up. But think of the amazing gain over the course of 1, 2, 3 weeks from jumping in after the Friday crossover on the following Monday, the 9th, at 121.30. And in the course of just 3 weeks, seeing it reach a high of 125.92. Now that's of $120-something ETF. That is an incredible gain over a short period of time. So instead of trying to call the market, we talk about this all the time, what do we try to do? We try to jump into the market when we actually see a trend developing. Not to predict the trend, but after it occurs, to jump on and ride that trend. Now, sometimes they don't work, and there are good reasons not to enter the market when it crossed over going down just barely on the 30th of December. And then, of course, it rotated around and headed up on the week ending the 6th of January. But getting in and jumping out when things don't go your way is something we talk about all the time. Not staying in and losing everything, but realizing that things do change. And once you have a confirmed uptrend, and again, when the market crossed over going down, you still had the derivative oscillator was in the positive, and it was just a short period of time until the market rotated right back over. We have the derivative oscillator on our charts for a reason. When everything lines up, derivative oscillators in the positive and the market rotates over, gives you every reason to look for a continued up move once you get in. If we go back, we look, excuse me, we look at the opportunity to jump into a down trade when the market rotated over going down for a short period of time on the 28th of October. We see that the jumping in point for it was somewhere around 119 to 116. And then the following week, the market super bottomed out at around 113.45. I mean, again, $3 to $5 in down movement. You might say, wait a minute, how do you make money when the market goes down? Well, on the Qs, like on all four of the ETFs that we look at, there are inverse funds that actually move in the opposite direction. They're called short ETFs. The one QID, actually, when things go down on the Qs, it's a short chart, so it actually goes up. When things go up on the Qs, it actually goes down, so you don't want to be in it then. But when you see things rotating over, it's almost like people who like options, puts and calls. It is a short option. Well, it's a short option for you to take. It's actually not an option, it's an ETF. But if you choose that option instead of getting into actual puts, it allows you to jump right in and follow down movements and actually make money. Or at least if you're in the Qs, you can rotate out of the Qs. That is, you can sell your position and wait for the Qs to go down and buy back in when it's cheaper. Why ride something down when you know it's going to go down? So as we look across the board, we can see the same thing as it happened in the S&P 500 when it crossed over going up back on the week ending the 25th of November. We also see when the Qs crossed over going down back on the week ending the 9th of September and then went down handily. We see where the Qs crossed over going up on the week beginning the 8th of July. And again, this is part of the problem when we start getting into the high summer is don't forget that old adage in the market, sell in May and go away. Why? Because a lot of the volume goes out of the market and it gets a lot harder to actually see good, clear trends that you see once the fall-winter trading zone kicks in and the money comes back into the market. And when the market starts to surge, either up or down, those changes tend to be less frequent and tend to be of greater intensity. So, what are we doing now? We are continuing to hone our skills, looking for weekly trends and crossovers. The latest that we've had happen actually occurred at the end of the week on the week ending the 27th of January, and we are at this point trying to determine, because things, even though the derivative oscillator is heating up, we see that the PPO has crossed over. We've looked at a buy-in point here, and gold can be so tricky. Unlike the green candles that we have seen on those other charts moving up, the week ended with a spinning top, which means lots of indecision. And so far in the week, gold is up 0.36%, and we did post a buy-in at 10:30 because the two-day chart was going up at 113.57. Now we're going to monitor this very closely. If the charts continue to rotate over and move down, particularly if we go to our 2-day chart and see it really break, and again, it's up for the day so far. It's actually flat on the PPO and it's losing energy on the derivative oscillator, but we're going to continue to monitor that. If it doesn't work, if it's a very short-term pop and rotates back over going down, then of course we will get out. But these trends, when the crosses occur, tend to work about 7 to 8 out of 10 times. And as long as when it doesn't work, you cut your losses. When it does work, you ride that baby up dollar for dollar for dollar for dollar. Then you're talking the ability to trend follow and make real bucks. And again, we're virtual trading. We're not a stock calling service. We're an education firm. We want you to practice with us. Once you learn the tricks that we teach you and you add your other knowledge to it and start making up your own mind when and if you actually want to invest, whether you're managing your own portfolio, you've got a self-directed IRA or 401k or whatever it is, it's your money. You make up your own mind. We're not a stock calling service. We don't get paid anything. We don't get paid to call any of that, and we're not. But we do want you to practice with us and learn and think about these things. Now, how do you make the best use of your time? You listen to our 10-minute daily podcast. In addition to that, once you subscribe at chartingwealth.com, we will send you 3 things along with your daily podcast. You will get a link to our How to Read a Stock Chart video. Take you 15 minutes to go over that. Invaluable information. You'll also find at the website all sorts of trainings like this one that are there for free. We will also send you a link to our layout that we use at freestockcharts.com. That's what you see on the videos every day. That's where that comes from. That link will give you the charts that we use. And then lastly, you will get our daily market worksheet that we encourage you to fill out on a daily basis. Once a week, you will chart your weekly trends of the 4 ETFs that we review every day. We go over the S&P 500, those 500 big volumes in the market, big companies. We also go over the Qs, which is the NASDAQ 100. That's QQQ. And like I say, we go over the S&P 500, and we go over TLT, which is a 20-year bond fund. And then lastly, we go over gold. That is what we cover. And from those 4 ETFs, you can learn all you need to learn about how the market really works. You can apply the knowledge you learn here to individual stocks. The reason we like indexes and ETFs in this particular training that we do, and we just want to make it simple. I mean, imagine if you're in a fabulous trade for Apple, and all of a sudden a plane crashes, and the CEO of Apple dies, or the whole management team dies. The stock could crash overnight. Less likely to happen with the whole market. And again, if you can pick trends, why in the world would you not go and find a trend that's developing, follow it on some big index like the S&P 500 or the Qs, or some big commodity like gold, or something like the 20-year bond? Much less likely to be affected by something crazy happening. Now, sure, a nuclear device could go off, a terrorist attack, the president of a country could end up having a stroke, and terrible things could happen that could affect the market, but less likely to actually have that big an impact that you can't otherwise deal with, the totally unexpected. Now, it can happen, but less likely, and we have ways to protect ourselves even when that occurs, and that is not through setting stops. We don't believe in stops. The problem with stops, and we've got a great training on that, is the minute that you are stopped out, your basket of goods that you're selling actually is then thrown into a market order, which means it can be sold at pretty much anything. If the market's crashing, you can be stuck in a line, and it gets ugly fast, as opposed to you setting up an email alert or watching the charts and paying attention to what's going on when you're in a trade, and then making up your own mind intelligently when to get out instead of having something triggered when the market makers know what it is you're waiting to do. Not a smart move. Folks, that's how we're going to wrap this up again. You have questions, problems, concerns, we're always happy to hear from you at Charting Wealth. We appreciate you. We appreciate your feedback. You guys can help us. We are all in this together. Everything we talk about here, we ask you to go and back test. Anything you see that we've miscalculated or anything that you have questions about or don't agree, we're happy to discuss that. We want to get better just like you do, and we work very hard back testing what we do to see that that occurs. Use this knowledge. Practice every day. 10 minutes is all it takes. But the one thing that people don't have to be great is perseverance. It's patience and perseverance. Perseverance, most of all, day after day after day. 10 minutes filling out that daily market worksheet, which is like magic for your brain, putting pen to paper, following as we go through each of these charts. It is magic for you. Thank you so much. Again, chartingwealth.com. If you're not already signed up for our newsletter, you need to do so. Follow us everywhere, Facebook, Twitter, Instagram, YouTube. Subscribe to our YouTube channel if you want to really help us out. Go to our iTunes channel, subscribe there, give us a 5-star rating, say something nice about us, let us hear from you. chartingwealth.com.